All right. Welcome back to the channel to everyone out there on YouTube. I've got another great video for you today, and it's covering a topic surrounding how you can grow a small account just trading one contract like me on the E-mini S&P 500. Now, you can do the same regardless of the market you trade, all right? Now, you may be simply asking yourself, how is that possible? How can you use one contract and flip your account, meaning being able to increase profits and grow it exponentially? I'm not saying at a fast rate, because when you're trading one contract, you have to do it step by step. It's kind of like a baby. You really got to crawl before you walk, those type things. Yes, it's the same thing. But if you have a solid trading strategy, you will be able to build, okay, your account size gradually. All right, but it all boils down to, it really comes back to the strategy you're using. I trade around supply and demand, okay, first and foremost, because it is the bread and butter or the cornerstone marking to the way that I trade on a daily. Why? You may be asking. Because supply and demand is so important. It's so powerful, because you're getting into a move where the aggressive buying or selling started at. Now, what is it that I look for and I must see happen or unfold? Number one, in everything I do daily when I'm trading, I must see a break of structure. Yes, a break of structure. I'm talking directly into the microphone because I cannot stress that enough. All right. That allows me, okay, when I see a break of structure, that tells me the market has still got the momentum, it still got the power to push in any given direction, whether it's up and down. Only two directions the market can go. All right. And what I'm looking for once I see the break of structure is an area where there is aggressive selling, to where, before that break of structure actually happened, an area where the market pushed hard to the upside, aggressive buying, or hard to the downside, aggressive selling, all right, that took out a broke structure to the upside or downside. That's extremely important. So yes, supply and demand is the cornerstone to my trading. It is the bread and butter and the glue to everything I do as a trader. I'm going to show you in this video here a couple of examples of what I'm talking about, just using one contract, okay? All right, going to run through it real quick, but I cannot stress that enough. I'm not saying that trading support and resistance, that you can't do the same, but to me, it's like, do you want to be at the cusp of taking a trade midway through a trade, meaning taking a break and retest back to an area of support or resistance, or wait for price to come back a little deeper, okay? Look for that area of aggressive buy-in, all right? And then get into it where the move is started at. Or the flip side, price pulling back to a key area where there's a lots of selling, okay? Where a lot of momentum and volume took place, all right? And take it back to the downside. It makes more sense to get in where there is, where the move, okay, is setting up, okay, to start happening. Not where, the midpoint of, where it actually had already moved, okay, all right, took its position, all right, and moved to the upside or moved to the downside, and you're taking a pullback right back to the midpoint of an area, okay? Just think about that logically. If you don't know much about supply and demand and you're someone new to watching, please take the time and go watch some supply and demand videos. I have tons of them talking about supply and demand here on this channel here, but we're not going to go into detail on what supply and demand is all about, okay? I'll leave that up to you and watch some of the videos here on the channel. But what I want to talk about first and foremost, there are some things that you're really going to need to grasp, all right, and incorporate into your trading plan. Things which I'd say not to do, okay? Not to do. Number one, okay, please do not trade around a news event, all right? Okay, meaning at the center of a news event, all right? I typically even wait a few moments after the market opens up if I'm trading the actual, once the session's open. Sometimes I'll trade pre-market. I'll wait 20, 25 minutes for kind of, things to kind of slow down in the market, all right, at first, all right? Number two, be consistent in your thought process, and be methodical about, the positions that you're actually going to take. All right, because there's what's called low probability and high probability setups, and be more logical about the higher probability setups. And I talk about that a lot in previous videos, okay? All right, never overtrade as well. Please don't do that, okay? Be patient. Like I said, be logical about the trades that you actually take. Don't ever feel like you're forced or pushed up or you're back against the wall just to be entering trades left and right. I see people, especially new traders, doing that time and time again. They think every move or every little setup is the best area to take a trade from. It's not. Trust me, okay? Be patient. Wait for the higher probability setups, and you'll be golden. And also, don't feel like you always have to be in a trade. Meaning, if your setup does not happen for you, and you're not able to execute using your strategy, you just don't see anything unfold for that day, then tomorrow's another day. Be patient, because that is the key in trading, is being able to sit back and wait for things to unfold. So if you don't see any setup, all right, for that day, then don't force your hand to click on that mouse to enter a trade to where you may end up losing some of your money, all right? Lots of people blow their accounts that way. So sit back. If nothing lines up on the chart, then don't trade that day. Tomorrow will be another day. You got 5 days mostly out of the week in which you can actually trade, all right? Some days kick off several setups. Some days kick off one. Some days kick off none. And if you're someone that also has FOMO, the fear of missing out on opportunities, yeah, we all can kind of look at the chart sometimes and say, man, I wish I was sitting in front of the chart and could have taken that trade. Look, stop worrying about things like that. It's one of those, I guess, psychological components that every trader suffers from. Even I see a great setup. I'm not in front of the computer. When I get back to it, I said, man, I missed an opportunity to make some money. But look, there's plenty of opportunities every single day. The next one is around the corner. So just sit back, wait, okay? That's the biggest thing about trading, okay? Is you have to protect your capital, protect yourself, all right? Protect your investment, protect the mental space for yourself. You have to protect, as traders, everything. We have to think methodically and everything, every move we make when we in this business of trading, okay? So think about things, okay? Really, really do. When price is at an area of demand, say for instance, using the demand as an example, do not be shorting, okay? Do not sell in an area of demand, and do not buy at an area of supply, okay? You will get smacked on your hand, you will get burnt, and you will lose money very quickly, okay? Understand that. Again, if you don't know much about or still in the process of learning supply and demand, please take the time to really grasp it, because it is powerful, powerful, powerful stuff. Understand that. Please do. Now, if there's other things that you could be doing throughout the day, instead of like sitting in front of the computer screen on your charts, hours upon hours, that causes fatigue on the mind, on the body, just sitting in a chair, just waiting for a setup. Find something else to do in the meantime. You go ahead and mark a level that you may have and wait patiently for price to come down to it. All right, go find something else to do. I mean, if you're trading from a office space in your home or wherever you're trading from, just get away from the machine and allow the market to get back to an area or zone that that you have resting or waiting for it to come back to. All right, just whatever it is. Don't try to trade out of pure boredom. Okay. Because like I said, if you force the hand, then that's when 9 times out of 10, that's when most people get burnt. Okay, that's when they lose money. All right, so step away, from the machine. And me, even as a trader, I have to step away from the machine plenty of times. And I've shown that in videos. I say, hey guys, I'm taking a break or whatever the case is. I may have a trade on, and I'll walk away, but I'll have a stop on. If I get up and walk away from the machine, I'm putting a stop on. But most times I try not to walk away or step away from my charts, unless most times it's something that's really urgent that I need to tend to for a short bit. But I'll get up and just, if I don't see anything, I'll step away, because it's mentally draining to just sit here looking, especially when the market is ranging, and it's just, I don't have that type of patience, okay? Just to sit there in front of the screen with my eyes glued to it, just hours upon hours, and I don't see anything, unfolding for me, okay? Now, I do want to say this, because people always talk about, or always want to question this one piece, is how much money do I really need to start off with? I don't ever tell anyone how much capital they should actually put it into their brokerage account to trade with, because everybody's situation is different. I just kind of have a rule of thumb, and this goes across the board, no matter what market it is. Try to have at least 10 times the amount, 10 times the amount or whatever the margin is. So like the ES is $400 a contract, right, to be able to trade it. That's the margin. So me safely, just being smart about it, I would say 10 times 400, 4,000. So excuse me, for every contract that I would be looking to trade, I want to have securely at least $4,000 in that account to be able to trade. Now, yes, it's way, you could, some people probably say, well, I could trade multiple contracts with $4,000. Yes, you can. And that's up to you if you choose to do so. But to me, I want to have enough room or money in my account in case, in the event that I take on a loss, I'm able to get back into and trade again. Yes, I'm going at a rate of $4,000 per one contract on the ES futures, and I use that same model, okay, regardless of the market. I don't care if it's crude oil or gold or any other industry out there. It doesn't really matter to me. I'm going with that same principle, the same rule. 10 times the margin per contract. Okay. Now that's just me. Okay. You do as you choose. All right. Now let's jump over to the charts, because I want to show you a couple of examples of what I'm talking about using one contract. And I'm not going to be taking any trades, but just with the mindset of using one contract. All right. Because you've seen, if you've been following the channel, plenty of my live trading sessions, as well as plenty of these screenshots that I post on the Discord. If you're not part of the Discord, again, please find the link down in the description portion of this video. We have over 1,000 community members, growing by the day, but there are plenty of community members on there that post their entries or screenshots of their entries on the trading floor, the channel on the Discord community called Trading Floor. And then that's where we as traders come together during the session and we post our trades. Okay, but again, you can find that type of information on the Discord as well as my live trades on the channel. But let's go into the charts now, get over and take a look, and I'll show you what I'm talking about using one contract, how you can grow your account. All right, so using one chart here, I'm using range-based charts. That's how I trade. Please do not ask me, because I get this all the time, why do I trade range charts? It's just simply a preference. That's all it is. The candlesticks just look cleaner to the eye. The setups look cleaner to the eye. I've been using them for over 10 years. If you trade time-based, tick-based, volume-based, whatever works for you, please stick with it. I'm just showing you, what and how I actually trade surrounding supply and demand using one chart, okay? All right, because I'm not saying that to pay attention to the higher time frames, do top-down analysis, but I'm just trying to show you in the intermediate time frame, let's say the market is, is bullish, okay? All right, and we're looking for a demand setup. So whatever the higher time frame is actually doing, look for demand setups. The market's bullish, look for demand setups. The market is bearish, look for supply setups. This case here, I'm just using this as examples as if the market was bullish, so I'm showing you an example of using demand. So we can see the market, was bearish here, even on the lower time frame, my 12 range chart. But then it turns around and we kind of, we start moving to the upside, making higher highs and higher lows. Now, that is a signal that should ring a bell in any trader's mind when you start to see the market shift and turn direction, especially when you get a break of structure and the market shifts and you start seeing higher highs and higher lows. That means the market is bullish, okay? Maybe even if it's for a short period of time, okay? But look, if the higher time frame is bullish and then the lower time frame starts to turn bearish and the higher time frame really hasn't breaking any means or area of structure yet and it's still bullish, I'm still looking to go long, because that short-term period where the market may be bearish on a lower time frame, that doesn't, it really doesn't close the chapter for me to really start looking for trades to go short. I'm still bullish because of the higher time frame, so I'm going to look for the market to turn around, start making higher highs and higher lows, and take trades in the direction of the higher time. Okay, so here's an example of a demand setup. Okay, we see the market is bullish to the upside, pulling back pretty tight, making higher highs and higher lows. And then it makes its high here. So it's making higher highs, higher lows, all the way back up to the upside. Makes a high here, pulls back, where the trace is pretty deep here, lots of selling. Took out a swing level here to turn back around, push higher, and break structure, taking out, let's just say 58, okay? Now, once it breaks structure, immediately, like I said earlier, I'm looking for a key area of demand, okay? We have demand resting down here, as well as a demand area right here, okay? Now, what I want to see out of a demand area, with aggressive buying, pushing the market higher, breaking through structure, I want to see an area where there is an imbalance or a gap. And there is one right here between the top end. You see this last red candle right here to the downside on this little swing to the upside, more aggressive, additional aggressive buying came into play at. We right here at the back end of this red candle where this wick is at on this red candle, as price broke above it, it did not come back down. So there's a gap from the top end at 52 right back up to 53. So about a 4-tick area gap in between this top end of that wick on that red candle to the bottom end of the wick on this green candle right here, okay? So look what happens once price breaks structure and pulls back down to this demand area. It rejects it, okay? So I'm looking to take an opportunity to go long once I get a break of candle in the opposite direction. So basically, once price turns back around, takes out this last red candle to the downside, breaks above it at 53 and say, or 54, I'm in the trade. Once I'm in the trade, where am I looking to get out at? I'm looking to take the trade to an area of liquidity above, pretty much. The back end of every swing or the bottom end of every swing can be considered as liquidity, okay? So right here at 60, once I'm into the trade, I'm looking to take the trade back up to, around the 60 area, okay? And it could push higher, but it does push higher if you actually look at it. It pushed right above and came up and tested this area right here at 63. So if you get in here, say at 54, take it back up to, I don't know if you want to say 58 or 60. Look, you can definitely pick yourself up between 4 or 5, possibly even 6 points on that trade right there using one contract. Okay, so this is an area, a setup based on demand, break a structure, demand zone with the imbalance or gap there. Take the trade in the opposite direction. Once price breaks the candle in the opposite direction, aim for an area of liquidity. All right, so let's take a look here at this demands area, okay? Look what happened, okay? Price was making runs to the upside, making higher highs and higher lows, right? Okay? Made a high here, broke lower, taking out the swing here. Boom, broke higher, took out liquidity at the top end. Now, for me, I would be aiming for this area back down here. Yes, it did take out liquidity, but what I'm trying to say is it broke structure right here at the top end at 74. So it pulled back here after making its higher high, break it through a swing, okay? Broke higher, all right? And this demand down here with a gap, okay? The gap is from the top end of that red candle right there to the bottom end of this green candle where that wick is at. So there's a gap or an imbalance sitting right there. So you wait patiently for price to come back to that area. Now, when price gets back there, what does it do? Yes, it does. Boom. It doesn't close below it, but it wicks out the bottom end of this low right here, okay? That is a liquidity grab, and that's fine. Because in lots of instances, once the liquidity has been taken, the market, they like to turn the market back around in the opposite direction to fake traders out. What they're trying to do is stop traders out, grab liquidity where they enter their trades to go long, grab the money there, and push the market higher. That's exactly what they did. But look what they did on the move to the upside. Made a high, higher low, higher high, higher low, higher high. Where is liquidity resting at? The back end right here, the back end right here, and down here. They moved the market lower, took out this area of liquidity, this area of liquidity, moved the market lower, stopping traders out here, taking money here, okay? Wicked it out, turned the market back around, and boom, pushed it to the upside. And what did they do? Made a new high. Broke higher, taking out this high right here. That is the type of fake outs and moves that they like to do each and every day. And that is their goal, is to aim and to clear areas of liquidity and stop traders out. Where am I getting to the trade at? The break of the candle in the opposite direction. This candle here, the red, green candle, taking out this red candle. My stop loss is primarily going to be right below this entry here at 54. If you enter with a hard stop. And where do you want to possibly look to take your first couple of contracts out? Back up in here. Okay. Liquidity resting right here at the top end at, say, let's just say 74, 75 in that area there. So you get in here at pretty much 59.5 or 60 area. Boom. Take it all the way up to 74. pick yourself up an easy 10, 8, 10, 15 points right there, somewhere in that neighborhood, you know, an easy 8 points for sure. Okay, so just be mindful of the type of plays that they're really trying to accomplish. When I say they, I mean the banks, the institutions, the market makers. What they're really trying to drive home at, what is their aim, their goal, and completion of at the end of the day. That is to stop us retail traders out. Okay, that is their bottom line goal, is to look in areas where liquidity rests at, where they can take areas out and get back into the turn the market back around. And that's what they did. The market was already running bullish to the upside. All they wanted to do was just grab some money, turn the market back to the upside, and boom. Okay, so they took out traders on the way down, and then they took those that was selling right here at the back end once they ran this high right here. It's as simple as that. If you follow this kind of strategy, this is what I use each and every day in my own trading, and this is using one chart, but you can also do this simply trading one contract at a time, looking for high probability setups. Break a structure where there's an area of demand and supply and back at that area of demand and supply, you want to make sure there's an imbalance or a gap, okay, that they need to come back to and fill. Look for the rejection. How or when price breaks a candle in the opposite direction, okay, and aim for an area of liquidity. That's pretty much all I have to cover in this video here. Hopefully that'll help. I kind of keep driving home at this over and over because I want people to grasp it and understand it. Now this is how I trade, so you don't have to mirror or use the way I trade. You can trade however you want to. Some people take it and they twist it, put their little own finishing touches on it, and adapt it into their own strategy. Okay, so however you want to use it, that's up to you. But that's all I have for you guys in this video. Hopefully you're able to take something home today or away from the video that you find have some value in the content. Okay, appreciate you tuning in. If you do not mind, please drop a like on the video. It helps out the channel. It helps the channel gain exposure so that other traders out there can find us. Okay, find us as a community. I'm giving this information away for free. I just want to see other people succeed and become profitable as well, and you will sustain profitability if you simply just for one, be patient. Okay, look for the right setups. When I speak of looking for the right setups, look for high probability zones, demand and supply. Now that's up to you to choose if you want to trade that or not. Maybe a support and resistance style trader. Whatever works for you at the end of the day is all I'm trying to say. But I thank everyone for tuning in and watching today's video. Please drop a like on the video. Please do so, as well as if you're not a subscriber, please take the time to go ahead and sub below. Click on the bell next to it. Turn your post notifications on so that you never miss one of the uploads here on the channel. I will see you guys in the next video. Take care and have a great day.